Hello, we are at the fag end of the year 2018. The stock market returns in 2018 has been poor. As I speak, for the year 2018, year till date, the Nifty is up by only around 3%. Nifty mid cap is down by around 17%, and Nifty small cap is down by around 31%. So the returns have been very poor this year, but that is very normal. If you look at the last 10 years, the market has shown negative returns 3 times and positive returns 10 times. But then the negative returns of the past turned out to be very positive and impressive returns later when the market appreciated. In the long run, the market performance will depend on the performance of the economy and the corporate earnings. So what is the global economic scenario and how is the Indian economy looking up? How the markets are likely to perform based on this global as well as Indian economic scenario which is emerging now. These are the relevant questions from the investor's perspective. Globally, a major challenge for the coming year is a possible slowdown. This year, the global economy did exceedingly well. The global economy was actually powered by the impressive growth of the US economy, which emerged as the global economic powerhouse again. But then there are signs of economic activity slowing down in the US. For US, this is the second longest period of economic expansion in history. And if the economy continues to expand beyond 2019 June, then this will turn out to be the longest period of economic expansion in the US. So it is not likely, because economic growth is not linear, it is cyclical, there can be a slowdown. So a slowdown in the US is a possibility. And China has already slowed down. China is now growing at only around 6.25%. Europe, of course, is growing at a very modest rate only. So emerging markets like India, which are doing reasonably well. So a slowdown is possible in the US, but not a recession. A slowdown in the US can turn out to be positive for the markets, because if there is a slowdown in the US Central Bank, the Fed, will not aggressively hike the interest rates. Already the markets are indicating that the 10-year bond yield in the US has come down. So that is indicating a slowdown. And therefore, if the Fed is likely to move to a dovish stand as far as monetary policy is concerned, then foreign portfolio investment into emerging markets like India will get strong. It will get stronger as the months go by. So, the market perspective, it is a positive, even though from the economic perspective, a global slowdown is a negative. Now, coming to India, Indian economy is doing reasonably well. This year, we are likely to end with a 7.4% GDP growth rate, 1890 financial year. And the next year, 1920, economic scenario is promising. A very important positive from the market perspective for the Indian economy is the sharp decline in inflation. Inflation in India is at a 1.5 year low. CPI inflation is 2.33%. Therefore, the central bank is likely to move to a neutral monetary policy stance very soon. Now the central bank is in a calibrated tightening monetary stance. It will move into a neutral policy stance in the next policy itself. And since the economy has slowed down a little bit compared to the Q1 GDP growth rate of 8.2, Q2 GDP growth rate is 7.1, and since inflation is cooling off, it is quite possible that the RBI might think of a rate cut and monetary accommodation in 2019. This augurs well for the markets. But then we have politics coming. The next few months will be very, very volatile because there is no clarity regarding the outcome of the general elections in 2019. So markets will continue to be volatile, very, very unstable. So the best investment strategy in this very volatile and unstable environment is to have a stable investment, a systematic investment through the mutual funds and investments in good quality stocks. While choosing investments, one can be very simple by choosing a multi-cap fund for long-term wealth creation, an ELSS fund for tax saving, a debt fund for short to medium term, and a liquid fund for a very long, very short term parking of money. As far as investment in stocks are concerned, investors should stick to good quality large caps and good quality mid and small caps. Investments in mid and small caps ideally should be done through a systematic investment plans, not directly. Therefore, the coming unstable environment, volatile environment should be managed with stable and systematic investment for the several months to come. Thank you.